Committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Examining Opportunities for Financial Markets in the Digital Era. Before we begin, I'd like to thank the witnesses for their participation today and for appearing before us. Hopefully this will be a little less drama than the hearings on both sides of the building than yesterday. Before we begin, I think that we're going to be having some great information to discuss today, and I thank you again. And so I now recognize myself for 3 minutes for the purposes of delivering an opening statement. This hearing is in regard to the U.S. Department of Treasury report entitled A Financial System That Creates Economic Opportunities, Non-Bank Financials, FinTech, and Innovation. Last January, this subcommittee held a hearing to examine developments in digital technology. Even since that time, the various ways financial services are offered and delivered has changed. Today, we continue our quest to examine the FinTech landscape and approaches to a smart and sufficient regulatory regime. This hearing will expand on the recommendations of the Treasury report and examine the current landscape, including the need to modernize the existing regulatory framework and develop legislative proposals to allow financial services entities to deliver new products and services to customers. The pace of technological development in financial services has increased exponentially and dramatically, offering both benefits and potential challenges to the U.S. economy and consumers. The reality is that innovation is critical to the success of the industry and the development of new products. It helps to serve consumers' financial needs across the globe, as well as potentially reduce operational risks for financial institutions. As more information becomes digitized, protection of consumer data becomes particularly important. We can't address innovation and growth without addressing the security of that data. I'm glad the Treasury report made that a priority. The department has clearly outlined the need for a single federal data security and notification standard that raises the bar for all industries and ensures a better outcome for all consumers. State authorities have attempted to harmonize standards, but the results have been stunted. For every state that's enacted a tough consumer notification requirement, 2 others have failed to address the issue. Harmonization must be a priority. 2 weeks ago, the Financial Services Committee passed the Consumer Information Notification Requirement Act, my bill that would codify data security safeguards and establish, for the first time in history, a mandatory consumer breach notification provision for all financial firms. The biggest challenge to innovation is regulatory duplication and fragmentation. Outdated and problematic regulations need to be overhauled, and growth must be monitored, but not necessarily slowed. We have a very distinguished panel of witnesses before us. The committee looks forward to hearing your diverse perspectives and appreciates the time you've taken to appear today. We thank you for your testimony. As Mr. Clay is not here, we will recognize him upon his appearance for an opening statement, but I do believe we need to continue as we do have votes scheduled here. I think it is now 11 o'clock. So with that, Chair now recognizes the Vice Chairman, gentleman from Pennsylvania, Mr. Rothfuss, for 2 minutes for an opening statement.
I thank the Chairman for yielding and for calling today's hearing. Our financial sector has undergone significant changes in the past few years. We have witnessed a distressing trend of consolidation and closures driven in part by overregulation. As a result, some communities have lost their local bank and some customers have lost access to services that they previously enjoyed. Regulatory reform and technological advancements can help the financial sector regain its vibrancy. I'm encouraged by ongoing developments in the FinTech space. It is important to note, as some of our witnesses will do today, that FinTech and traditional banking do not need to be adversarial. Bank-FinTech partnerships are common and they can help institutions augment their services and reach new customers. I am encouraged by this administration's work to ensure that non-bank lenders and FinTech firms are subjected to clear and robust rules while facilitating continued technological progress and allowing for healthy competition. I look forward to hearing from our witnesses, and I yield back.
The gentleman has yielded back. The ranking member prefers not to have an opening statement, so with that, we'll go right to the testimony today. Okay. Very distinguished panel today. We thank all of you for participating. Mr. Aaron Cutler, partner for Hogan Lovells LLP. Mr. Dion Harrison, director at Elevate. Mr. Michael Price, President and Chief Financial Officer, First Commonwealth Financial Corporation, on behalf of the Pennsylvania Bankers Association, and Mr. Rothfuss would like to make a special introduction of him.
Thank you, Mr. Chairman. Yes, Mr. Price is the President and Chief Executive Officer of First Commonwealth Financial Corporation in Western Pennsylvania and a constituent of mine. He sits on the board of the Pennsylvania Bankers Association, and he also serves on the Community Depository Institutions Advisory Council of the Cleveland Fed and the Business Advisory Council at Indiana University of Pennsylvania. Mr. Price grew up in Johnstown, Pennsylvania, which is also in my district. He earned a degree in finance from the University of Utah and an MBA from Cleveland State University. Mr. Price, thank you for testifying today, and I look forward to getting your perspectives. Yield back.
The next panel member is Mr. Scott Estrada, Director of Federal Advocacy, Center for Responsible Lending, and Mr. Stuart Rubenstein, President, Fidelity Wealth Technologies. Each of you will be recognized for 5 minutes to give an oral presentation or testimony. Without objection, each of your written statements will be made part of the record. Just a little bit on the lighting system. Red or green means go. Yellow means you have 1 minute to complete. Red means hopefully we can wrap it up very quickly and stop. We do want to get done by 11 o'clock. Not that this is not an important hearing. Make sure everybody has a chance to get all their questions asked and make sure all the answers are here. But we do need to make this as compact as we can. So with that, again, I indicated to you, please pull the microphones close to you. The lady at the end needs to transcribe the activities and needs to be able to hear everything that happens. As I told you, my wife screamed in both ears, and I have a hearing deficit problem, so you need to pull it close so I can hear. So we're excited, though, for all of you to be here today. Mr. Cutler, you're recognized for 5 minutes.
Thank you, Chairman Lukemeyer, Ranking Member Clay, and members of the subcommittee. My name is Aaron Cutler, and I'm a partner at the law firm of Hogan Lovells. Any statements I make reflect only my opinions and do not necessarily reflect the opinions of my law firm, colleagues, or clients. My full written testimony has been entered into the record, and I will now give an overview. At the outset, I would like to stress that I support agile and effective regulation that enables the creation, development, and deployment of safe, sound, and innovative consumer financial products and services. FinTech products and services are already in use and continue to be rapidly adopted. As noted by the Treasury's recent report, up to 1/3 of U.S. consumers who are online use no less than 2 FinTech services. As GAO reported in 2016, the U.S. financial services regulatory structure is complex and contains areas of fragmentation and overlap that lead to an inefficient regulatory structure. Several of the recommendations contained in the Treasury report identify areas for improvement and increased efficiencies. Overall, the Treasury report is a call to action. Taking action on many of the recommendations could improve the regulatory framework. These improvements stand to benefit FinTech entities, the industry at large, and consumers. Financial institutions are sitting on a gold mine of insightful data about each of their customers' spending habits and use of funds. In the right hands, this data can be used to promote sound financial management, assess risk, and support consumers. It can also help with digital identity verification or even to make risk assessments for insurance products. In many cases, however, it is not the financial institutions themselves that are best able or motivated to carry out this analysis, but innovative third parties with greater expertise in data analytics. However, financial institutions and data aggregators often find themselves at odds over data sharing. This is part due to the prevailing regulatory regime. Currently, financial institutions face uncertainty regarding their liability for sharing consumer account data. The Treasury report recommends that the Bureau confirm that third parties given consumer authorized access be covered under the definition of consumer under Dodd-Frank for the purpose of sharing financial account and transaction data, thereby requiring financial institutions to share the data with these third parties. In my view, the overriding concern when setting a framework for open access to transactional information should be to ensure the security of the account and credentials, facilitate the customer's freedom of choice, and to allocate risk and liability appropriately to protect the customer. Many FinTech companies are subject to the authority and supervision of state banking departments and other financial services regulatory agencies. Under the state regulatory regimes, FinTech companies are often required to obtain some form of state licensing and registration. State applications may ask for detailed information about the company, key employees, executives, and owners. The information requested may also slightly vary between states, even though the objective is substantially similar. The Treasury report identifies the state oversight and harmonization challenges faced by entities offering financial services products across multiple states. Thus, it recommends creating uniformity to streamline state supervision and licensing, such as adopting reciprocity-type measures to help reduce redundancies in the licensing and registration process. I fully support this recommendation. Regulators and industry participants alike will also benefit from the information obtained by testing new innovative technologies. The purpose of a regulatory sandbox is to create an environment for firms to try out new ideas without threat of regulatory penalty. By providing this environment, regulators expect to create a range of beneficial outcomes, such as reduced time to market for new products and services due to firms having greater certainty as to the regulatory treatment of those products and services, better access to finance for firms seeking to raise funding for their new products and services due to investors having greater comfort that the business will be viable from an operational and regulatory perspective, the development of more innovative products due to firms having the ability to test ideas in a supportive regulatory environment, and better outcomes for consumers due to the better quality of testing that can be applied within a sandbox environment. Also, the use of a sandbox enables the regulators to provide input on consumer protection features at an earlier stage of the product development process. In the UK, for example, the Financial Conduct Authority has established a domestic regulatory sandbox, which has been used as a model for other sandboxes around the world. In conclusion, the Treasury Report is a very good start, and I commend the Treasury Department on its publication. Thank you.
Thank you, Mr. Cutler. Mr. Harrison, you're recognized for 5 minutes.
I want to thank Chairman Lukemeyer and Ranking Member Clay for asking me to appear today to discuss opportunities for financial markets in today's digital era. My name is Dion Harrison, and I'm the Director of Products at Elevate. I have over 20 years of experience in the consumer credit industry, and now I'm proud to work at Elevate, one of the leading FinTech companies in the United States. I'm proud because we work hard to fulfill our mission to serve good customers in disadvantaged circumstances today, and provide products that help them to have a better tomorrow. We're also building consensus around key policy issues through our trade groups, TechNet and the Online Lenders Alliance. Headquartered in Fort Worth, Texas, and with an office in San Diego, we've served over 2 million American families through the origination of almost $6 billion in non-prime credit to date. We're the only FinTech company to cap our profits so we can reduce costs to consumers. We've lowered our APRs by over 50% since 2013, saving consumers over $4 billion compared to payday lenders. And we have a customer-centric approach to designing and underwriting all of our products. As members of this subcommittee know, the U.S. is still recovering from the events of 10 years ago, which have significantly reduced the credit available to non-prime consumers by over $140 billion to date. Banks took a step back, and small dollar options for consumers evaporated. The 160 million Americans with credit scores below 700, who we call the new middle class. To truly understand the needs of consumers affected by these changes, Elevate created a research institution called the Center for the New Middle Class. The results of our research so far has given us key insights. African Americans are 80% more likely to live paycheck to paycheck. They are also 2.5 times more likely to overdraft their bank account. Hispanic non-prime borrowers are more likely to experience higher levels of employment and less volatile income, but less than 1 in 10 have a retirement account. What rings true about our research is that these Americans need access to better small dollar loans, and my experience tells me that partnerships between FinTech companies and banks are the key to building safer, more accessible, and inclusive financial products. FinTech is already helping consumers by increasing short-term credit access, developing payment platforms, and helping consumers make better financial decisions with new tools. To build upon the momentum in our industry, Congress and industry stakeholders should come together on the following principles. Regulation should be pro-consumer and enable innovation. Partnerships between banks and FinTech companies should be encouraged. Congress should act by passing legislation that clarifies and fuels the creation of safe, superior products. As with any innovation, there will be staunch supporters and fierce critics, but I'm confident through transparency, honesty, and results, Congress will see that leveraging the strengths between banks and FinTech companies is a powerful and positive solution to filling many of the gaps in our financial system. Bank FinTech partnerships are a win-win-win. Banks are able to offer products to position themselves for the future of a rapidly evolving industry. FinTech companies like Elevate are able to efficiently utilize data and analytics to better design and market safe financial products. And consumers get access to credit solutions that are quick, safe, and transparent. Consumers are also able to escape bank deserts. As Representative Meeks recently noted, FinTech products can build a truly affordable and healthy financial system for everyone. Congress should ensure consumers continue to benefit from these partnerships. I first want to thank this committee and the House for passing a large bipartisan majority, H.R. 3299, which clarifies valid when made. Similarly, I hope this committee will pass H.R. 4439, which clarifies the true lender issue. Furthermore, we must address the lack of diversity in FinTech and technology more broadly. As Congressman Cleaver recently stated, there are serious ramifications when companies don't have a diverse workforce and don't understand or align with the communities that they serve. We must work hard to hold each other accountable. In our business, we use alternative data sources to reach new consumers and evaluate the risk drivers in affordability and delinquency, but we must remain vigilant that our processes do not include bias. And we must all be on the lookout for bad actors who intend to create predatory products targeted at not just non-prime, but all groups of consumers. I want to thank you for inviting me today, and I look forward to answering your questions.
Thank you, Mr. Harrison. Yields back. Mr. Price, you're recognized for 5 minutes.
Thank you. Chairman Luetkemeyer, Ranking Member Clay, and members of the subcommittee, my name is Michael Price, and I'm the Chief Executive Officer of First Commonwealth Bank. Our community bank is privileged to help thousands of consumers and family-owned businesses buy homes, pay for college, expand facilities, and hire new workers every year. I'm grateful for the opportunity to participate in this important hearing and offer my perspective as a community banker. In my brief testimony, I want to stress 3 points. First, community banks embrace and support responsible innovation within our industry. Second, I want to stress the vital and visible presence of community banks throughout the country. Third, I want to emphasize that consumers and small businesses are best served when all providers of financial products and services are subject to a consistent and level regulatory and supervisory playing field. First Commonwealth has served as a trusted provider of financial services for over a century. We embrace innovation to better serve our customers. Financial technologies present tremendous opportunities to customers and banks alike. Technology empowers consumers to manage their financial health and affords access to credit for more borrowers. We continuously invest in technology to provide state-of-the-art solutions, from mobile banking, mobile wallets, and mobile deposit to a financial management application that teaches and empowers our customers to budget, save, monitor spending, and plan for the future. Our innovation occurs within the framework of bank regulation and supervision, and a culture of compliance and risk management that ensures that all new products are safe and secure before they get into a customer's hands. In short, community banks deliver innovative products through channels customers can trust. However, technology does not replace a community presence. While First Commonwealth is embracing technological innovation, we remain a visible presence supporting our communities as we always have through countless hours of volunteering, something that cannot happen through a computer or mobile device. We understand our customers and stand behind them in good times and bad. We engage with our communities, partner with local businesses, and will have the capital and wherewithal to lend through the next economic cycle. We make a difference. My team in Indiana, Pennsylvania serves in leadership roles at a local university, hospital, drug treatment facility, high school, Chamber of Commerce, United Way, YMCA, food bank, and homeless shelter, just to name a few organizations. Besides our time, we also give generously to these local charities and many more. We care about the vitality of our communities. As a community bank, First Commonwealth is appropriately subject to extensive regulation and regular and rigorous examinations. We adhere to regulatory guidelines for vendor risk management to ensure that service providers have robust compliance and information security programs. Non-banks offering similar services do not have the same level of oversight. This can allow problems and security vulnerabilities to go undetected to the detriment of consumers. As a bank, we are regularly examined for a fair lending compliance. While non-bank lenders may be subject to fair lending laws, they are not routinely examined for compliance unless a consumer complaint triggers an investigation. I believe customers should expect the same reliable experience and protections whether dealing with a bank or a non-bank. The best way to achieve a consistent customer outcome is for regulation and, more appropriately, supervision to be based on activity rather than the type of company that conducts the activity. Many of innovations at their core are traditional banking products offered in new ways. By focusing on the activity taking place, regulators are best able to assess the risks being presented to consumers and the system. Activity-based regulation and supervision would level the playing field and ensure that consumers enjoy the same protection and benefits across the vast landscape of financial service providers. Once again, thank you for the opportunity to offer my perspective and for your attention to the importance of responsible innovation in financial services. Thank you very much.
Thank you, Mr. Price. He yields back. Mr. Estrada, you're recognized for 5 minutes.
Thank you. Good morning, Chairman Luetkemeyer, Ranking Member Clay, and members of the committee. Thank you for inviting me here today to testify about the opportunities and challenges posed by FinTech in the financial services marketplace, the current regulatory and consumer protection landscape, and the need to ensure that emerging products and market participants best serve consumers. I'm the Director of Federal Advocacy at the Center for Responsible Lending, a nonprofit, nonpartisan research and policy organization dedicated to protecting homeownership and family wealth by working to eliminate abusive financial practices. CRL is an affiliate of Self-Help, a nonprofit community development financial institution. In total, Self-Help has provided over $6 billion in financing to 70,000 homebuyers, small businesses, and nonprofits, and currently serves more than 80,000, mostly low and moderate income consumers through 30 retail branches. This important hearing addresses how technological innovation has resulted in the development of new services and delivery platforms by both traditional financial institutions and non-bank FinTech companies. The rapid expansion of market participants and their products has brought new opportunities as well as significant consumer protection concerns to the financial marketplace. In my written testimony, I discussed in detail the essential legal questions and consumer protection issues that are necessary to be at the center of this broader FinTech dialogue. Specifically, in relation to the recent Treasury FinTech report, CRL, along with numerous civil rights groups and state attorneys general, have expressed significant concern about the impact that the Treasury report's recommendations would have upon consumers. We reviewed the report, as we do FinTech in general, in the context of our central priorities. First, preserving the progress made by state and federal stakeholders to guard consumers from predatory debt trap products. Second, ensuring FinTech lending evolves in cadence with existing and developing consumer protection laws. And third, the preservation of state usury laws. CRL is very wary of unscrupulous actors and payday lenders adopting the banner of FinTech with the purpose of evading consumer protection laws, particularly state-level rate caps, while also using the veil of innovation as a justification for exemption from long-standing consumer protection laws and regulations. Ultimately, there's no getting around the fact that a bad loan is a bad loan, regardless of whether it's delivered through a technologically advanced medium or algorithm or a storefront. At the same time, we are well aware and very encouraged by the potential benefits of FinTech, especially as it relates to affordability and financial inclusion. So CRL is dedicated to ensuring that consumer lending marketplaces are fair, transparent, and equitable, and we are appreciative of the opportunity to contribute to this discussion. While we are all admittedly unsure of what FinTech can deliver over the long term in terms of financial inclusion, we do know for a fact what happens when consumers are left in the crosshairs of predatory lenders. Short-term payday loans and car title loans cost borrowers $8 billion a year and many times lead to other significant financial challenges: overdraft fees, loss of a checking account, debt collection costs, even bankruptcy. The evolving FinTech marketplace should focus on historically proven consumer protection laws and the components of responsible, equitable, and wealth-building lending. We have a unique opportunity with the emergence of FinTech to build strong consumer protections and equitable financial access at the front end of FinTech development and into the very foundation of the marketplace itself. Furthermore, we have an opportunity to correct and remedy the current marketplace inequities that have become systemic by ensuring consumer protection is an integral part of the financial marketplace. If we get this wrong, we will set the stage for future generations to suffer from the same financial inequities of the past. However, if we do this right, we could set a trajectory for millions of Americans toward economic prosperity. Thank you again for the opportunity to testify, and I look forward to answering your questions.
Thank you, Mr. Estrada. Mr. Rubenstein, you've got a really high bar to hit here because every one of those guys came in under the 5 minutes. You're recognized for 5 minutes, sir.
Thank you, Chairman Luke Meyer, Ranking Member Clay, and members of the subcommittee. My name is Stuart Rubenstein. I am President of Fidelity Wealth Technologies and Head of Data Aggregation at Fidelity Investments. Fidelity is a leading provider of investment management, retirement planning, brokerage, and other financial services to more than 30 million individuals, institutions, and intermediaries with more than $7 trillion in assets under administration. We're also strong supporters of fintechs and a major fintech investor. I'm appearing today to represent Fidelity with a specific focus on the topic of financial data aggregation. At Fidelity, we have a unique perspective. We're an aggregator ourselves, and we are also a source of data to aggregators who act on behalf of our customers. Fidelity is a strong believer in the benefits our customers receive when they can see a consolidated picture of their finances. We have offered aggregation services to our customers for well over a decade, and our customers have been able to access their Fidelity data through various third parties since the 1990s. But the cybersecurity environment has changed, and risks have become far more pronounced and must be addressed. First, most financial data aggregation that occurs today requires consumers to disclose their financial institution username and password to the third-party aggregator or fintech. While this process may have worked in the past, there are new technologies that eliminate any such requirement. Because cybersecurity is of paramount importance, we believe that customers should not have to disclose their username and password in order to use any third-party service. Second, aggregators using credentials may have access to an entire website or mobile app, which means they can access more data than may be necessary to provide their services. For example, a simple app that tracks your spending does not need to know your investment holdings, but it will have access to that under the current methods. Because of the advancement of cyber threats, Fidelity and others in the industry have been working hard on developing a different approach to data aggregation that helps to protect consumers. At Fidelity, we've developed 5 principles for empowering consumers to share their data safely with third parties. 1, consumers should be able to access their financial data account data wherever they want, when they want it, and through third parties. The question becomes not if they can access their data, but how. 2, access must be provided in a safe, secure, and transparent manner. 3, consumers should provide affirmative consent and directly instruct their financial institutions to share their data with specific third parties. 4, third parties should access only the financial data that they need to provide their services. This should not be a Trojan horse for the gathering, accumulating, and reselling of consumer data. And 5th, consumers should be able to monitor account access rights and direct financial institutions to revoke that access. To back these principles with action, Fidelity announced in November of 2017 a new service called Fidelity Access. Fidelity Access will allow customers to provide third-party access to their customer data through a secure connection and without providing login credentials to any third party. The most difficult issue standing in the way of wider adoption of safer data sharing technologies is the issue of responsibility. We believe companies that collect and handle financial data should be responsible for protecting that data and making consumers whole if misuse, fraud, or theft occurs. As we've been discussing Fidelity Access, we've seen aggregators try to limit liability, some to very small dollar amounts. Fidelity believes firms that obtain and handle consumer data should be held responsible to protect that data from unauthorized use, just as we are. Any other standard creates moral hazard and does not require aggregators to take their data stewardship responsibilities seriously. Finally, the complexity of 50 different state laws to notify a consumer of data breach is significant. We're encouraged by the committee's recent consideration of legislation to create a single federal data breach notification standard. Consumers could benefit from a uniform federal standard that requires clear and timely notification of a material breach of personal information. Thank you again for the opportunity to testify before you today. I look forward to answering your questions.
Thank you, Mr. Rubenstein. Well done. The chair now recognizes himself for 5 minutes to begin the questioning. Mr. Cutler, you've written extensively on the growing FinTech marketplace and what the challenges are in innovation. I know you talked a little bit about the regulatory sandbox, and how do you believe that it's best structured? Is it to allow the FinTech company before it's chartered, after it's chartered, whenever it becomes a part of a bank or credit union? Excuse me. Other entity, or should you just allow the FinTech company before it ever becomes affiliated to be in a sandbox to develop its products? Can you just elaborate, please?
Thank you, Mr. Chairman. Actually, I think before they become a FinTech, before they get their charter, would be a good place to allow them to enter the regulatory sandbox early on in that process as they're trying to figure out where they should go. Should they enter into a partnership? As they're figuring it out, it'd be good if they can be part of that sandbox.
I would assume that that company would have to show that it's viable to be able to be doing something like that. I mean, you can't just have somebody come in with an idea and a whim and be able to get a safe harbor here to go develop a product. Would that be?
No, absolutely. They would have to, open kimono with the regulators at that point and have that conversation.
Okay, very good. Mr. Price, you talked a little bit about some of your FinTech activities, and last night I was at I met Mr. Barrs, one of his constituents, who is a banker from Lexington, and they were using tellers, I guess, at kiosks instead of a real teller. It was a teller who I guess was technologically behind a screen somewhere, and they were able to talk to him on another screen in the lobby. So they didn't really have any physical people in the lobby, but they had some physical people actually doing all this. And have you done some research to see? I guess I'm curious about the numbers. What kind of people would be interested in this? Last night the banker was adamant about they did the research to show that this is something people wanted, but I saw some numbers recently that indicate even the millennials, only 6% of the people didn't want to touch somebody. 51% of them did want to touch somebody. They wanted to be able to, at some point, be able to go to a teller and be able to talk across the counter. So what kind of numbers can you talk to us about this morning?
Yeah, thank you, Mr. Chairman. The numbers I recently saw, actually 2 days ago, from an industry expert was 46% of people still go in the branch, and now 54% do things totally digitally. And when they have a problem, they still want to get somebody by the throat or hold their feet to the fire and get in front of us at the branch. But those are the basic numbers. And I have to tell you, I think Congressman Rothfuss said this isn't adversarial. It really isn't. I mean, we have mobile wallets. We have online lending. We have the same kinds, the kiosk idea. I mean, we think about our customer interface digitally. Those are the types of things we're exploring as we speak. Umpqua, just in the last week, came out with a concept, Best Banker Forever, where you're interacting with a person mobily. So the FinTech companies have really pushed the space, and I think will make it terrific for clients, and we look for all kinds of opportunities to partner with them, and in fact, we're already doing that.
I assume, though, that there needs to be some sort of structure in place to be able to make sure this is done. Now, Mr. Rubenstein made some great points here with regards to aggregating data and access for people to that data, but also trying to find a way to protect that data. I mean, there's a line you have to walk here.
There is, and I would just say a bank charter is a bank charter. No bank light charters, regulatory oversight exams if you're engaged in banking activity, and that includes the full enchilada, things like CRA, HMDA, fair lending, and not just laws, but also you have to have supervision. I mean, when the examiner comes in and takes 40 or 50 of my loans and grades them, that's a different bar than if somebody sues me civilly, because I'm accountable quarterly for exams and exam outcomes.
Mr. Rubenstein, you'd like to comment on that, my last comment a little bit, elaborate on your testimony?
Very, very simply, different firms have consumer data, and right now are held to different standards, right? We have banking standards. The SEC has standards on firms like us. FinTech firms are able to use that data and provide very helpful services, but they're not subject to the same standards. And I think that that's, at the end of the day, it's sort of a level playing field. The consumer, I don't believe a consumer understands the difference if one firm holds their data or another firm does. So we just want to make sure we have those same protections.
Thank you. My time has expired. With that, we go to the gentleman from Missouri, the other gentleman from Missouri.
Thank you.
Mr. Clay, recognized
Thank you,
for 5
Mr.
minutes.
Chairman, and let me thank the panel for their participation in this hearing. I'll start with Mr. Estrada. I see that the Center for Responsible Lending was listed in Treasury's FinTech report as being an organization the department consulted with. Can you please share with us how your meetings with the department went, and did they take your advice?
Thank you. More than happy to share. I will start that we did not actually meet with Treasury, despite being listed in the appendix. To be as forthcoming with the committee as possible, the process was earlier this year. Treasury staff reached out to us to come in and talk about the report, and I was the designated lead. I responded, said we'd love to come in and talk, as we usually do. I did not receive a response to that email. I followed up a few weeks later and did not receive a response to that email, and followed up one last time a month after that and did not receive a response. So we were quite surprised to be listed in the appendix. We assumed the best and that it was technical oversight.
I wouldn't go that far, but I'm sure that's something Treasury can answer for us. Let me ask you about what are your views on creating some kind of regulatory sandbox for FinTech? Are there certain aspects of the FinTech landscape that would be better suited for such a sandbox, and what kind of parameters would you place on a sandbox?
That's a great question, and I'll zoom out from the consumer experience aspect of it in terms of the terminals and branches and talk about the policy and process aspects and our concerns with that. On a broad level, it really is a bad deal for consumers. It's kind of trading well-established, long-established consumer protection laws, especially as it comes to civil rights and anti-discrimination, for the promise of innovation for the broader society. I think one of our just initial issues is innovation is one of those terms that if you ask 10 people what it means, you get 11 answers. And that can really be stretched, either from a product level or even nefariously in terms of, delivering predatory loans through new technological platforms is not innovation and is not deserving of any exemption, in fact, quite the opposite. And I think the process of cutting out stakeholders, community, consumer groups, civil rights groups, not going through notice and comment, not going through the well-established APA procedures to, again, double down on this notion of a very vague conception of innovation is very problematic. And on the consumer level, if you really talk about the permanency of some of the negative impacts that can follow individuals their whole lives, if not generations, that you might have a great exit plan as a business if it fails, but what about those consumers? And the only thing that comes to mind is an Atlantic article from earlier this year based on MIT study that says to escape poverty, on average you need 20 years with nothing to go wrong. No medical emergency, no job loss. That's a crazy amount of time. And if you talk about regulatory sandbox, especially in financial inclusion, you set up for a trade-off between well-established civil rights laws for this promise of innovation that's not even strictly defined, and the consequences can follow individuals for their whole lives.
And just as a follow-up to Mr. Harrison, how does Elevate protect against unintentional discriminatory practices?
So thank you, Congressman Clay, for...
Can you turn on your mic?
Thank you, Congressman Clay, for that question. So Elevate is very focused on making sure that we protect our customers in every way. And we have leveraged a lot of different types of data in order to more broadly serve customers that are in disadvantaged areas. And in fact, we take it very serious to make sure that we're in compliance with regulations also. We're subject to, with our bank partnerships, we're subject to the same regulations that all of our banking institutions are. And we do internal reviews ourselves so that we can kind of make sure that we're monitoring and checking ourselves for our fair lending practices, but we also get third-party validation of all those. Those are independent reviews that we do on a very regular basis to make sure that we're in compliance with those.
And
We
the
report
data
those to our-
differs from the banking, the brick and mortar banking industry?
Yes, sir. And we absolutely, whenever we partner with a banking partner, we adopt their policies on fair lending and such, so that we are always subject to those regulations, and we hold ourselves accountable to that. And we provide our reporting of the independent audits, and they have the right to also come in and audit us as well to make sure that we're in compliance with all those policies.
I'm sorry, Mr. Chairman, I went
No, it was a
over.
great question. Thank you. Thank you for that. Gentleman's time has expired. With that, we go to the gentleman from Pennsylvania, the Vice Chair of the committee, Mr. Rothfuss, for 5 minutes.
Thank you, Mr. Chairman. Mr. Price, I want to talk a little bit about something you said in your testimony about the importance of having a community presence. As we see the ongoing evolution in society, things moving digitally, and people liking the convenience of that, here is this issue of the presence in the community. What do you mean by that? You might.
I think we can have the best of both worlds, digital, and I think community and banks should thrive in their communities. I think it's important we know our borrowers, our businesses. We're the #2 SBA lender in Western Pennsylvania as a relatively small bank, because we're in the towns and we know the people and we're connected in the communities. There's a lot of projects that happen in a community that wouldn't happen without that kind of knowledge in a community. For example, we just did a drug and alcohol facility in a small town. We had raised the money with local businessmen as seed money. We encouraged, coached, and counseled the leadership team. 2 community banks came together to fund that enterprise. It's been up 2 years. It's very successful. It was coordinated with the public sector, public officials, businesses, healthcare. You know, those are the kinds of things that happen with hospitals and retirement facilities and community banks and others are at the vortex of, that I just think are really important and make a difference in the economic vitality and the growth of those places and their livability. And I'm proud to say that we do that, and it's fun too.
You also talked about bank FinTech partnerships and the mutually beneficial relationships that traditional banks and startups can develop. Can you describe some of the partnerships that First Commonwealth has with FinTech companies today?
Yeah, we do a lot, quite frankly, through our core technology provider, who forges those partnerships on our behalf. Bigger banks buy FinTech companies. Smaller banks necessarily can't, but we can still have access through them through our core provider, and there's 3 or 4 large core providers of technology.
So you don't see an option for a bank your size to purchase a FinTech company?
No, and that puts us a little bit behind the starting line. There's no doubt.
Mr. Harrison, in your testimony, you encouraged partnerships between banks and FinTech companies. How do these partnerships help the firms serve more consumers?
Thank you, Congressman, for that question. I think in the case of Elevate, we have spent the last decade ensembling lots of different types of data to make sure that we can reach a broader group of customers. Traditionally, there are companies such as Experian and Clarity that have actually partnered together to make sure that they understand where customers are actually spending their money or borrowing money from. And we can take that information and get a more holistic view of where our customers are actually lending or getting money from. We then kind of take that information and we provide it to banking institutions to show them that there's a different way of actually underwriting, there's a different way of reaching those customers, and that there are people that are actually invisible to the credit, to the mainstream credit profiles today that absolutely are disenfranchised and live in banking deserts and that can't reach a community banking institution that we can start to find for them.
If we can follow up on that, because I know the ranking member was bringing this issue of reaching out and serving those underbanked communities, minority communities. I want to talk a little bit about the how. How can this work? How can FinTech help to provide services to more minority borrowers who are currently underbanked? How does that process go?
I think Mr. Price actually hit the nail on the head that the community banking institutions are still a trusted entity within their community. And I think that we would like to enable.
But if there's a community that doesn't have an institution,
yes, that's absolutely correct.
so how can that be leveraged to reach those folks?
Well, through our technology platforms, we do a lot of online platforms that allow customers to find us over the internet. And we've been able to reach a number of different customers that do live in areas that are, typically considered to be geographically banked deserts. We are going into those communities that are probably more predominantly, have check cashers and payday lenders in their community, and we can take them away from those because we can provide a better alternative solution and a much more cost-effective and safe product for them.
Thank you. Yield back.
Gentleman yields back. With that, we go to the gentleman from Texas, Mr. Green, recognized for
Thank
5
you,
minutes.
Mr. Chairman. I thank the witnesses for appearing as well. If I may, I'd like to start with the notion that the OCC may be accepting applications for a FinTech special purpose national bank charter. And I'm concerned about this because obviously there may be some predators out there who can see opportunities. I'm also concerned about how this will impact the CRA. As you know, there are moves afoot to revise, reform, somehow amend the CRA. So let me start with you, Mr. Estrada. Would you kindly give me some indication as to the concerns with predatory lending as well as the impact on the CRA? And I'm going to give you about 2 minutes to do it because I have another question.
Thank you. I'll be quick. Thank you for that question. And the OCC FinTech Charter really is a big concern of ours in terms of the written testimony I submitted, and the preemption of state usury caps is one of the best protections we've seen against predatory lenders. And I think what we have to step back and realize is that, 10 years ago, it was a research question if payday loans were bad. That's no longer an argument. That's settled, and I think it's settled in academia, it's settled on wide swaths of the industry. Now, what happened is that kind of evolved with FinTech into high-cost lenders migrating to online saying, well, we're not payday lenders, we're different. Or simply relying on a consumer choice theory that individuals should be free to choose whatever they want. CRL has serious issues with both of these, and I'll spend time on the former, is that the bank partnership model is not what we're here to argue about. What we're here to argue about is the explicit preemption of state interest rates across the whole country that has shown, a model that has shown—
1 minute left.
Okay, you can't separate substance from form. So this bank partnership for decades has shown a propensity to be taken advantage of by unscrupulous lenders, even more so in the FinTech space. Under previous regulators, that was shut down in the 2000s, but we've seen this spring up again and again with many lenders, and this is an unequivocal loophole for these lenders to kind of hijack whatever the explicit intention of the OCC is to provide financial inclusion. And without addressing the state preemption issue, without addressing the reality that this partnership model has clear openings for predatory loans, it is ill-advised, and we strongly oppose the move.
The CRA quickly.
And CRA, I think, is directly related to this in terms of using financial innovation as a narrative to say why CRA is broken. It's not. It's worked. It's continued to be one of the main drivers of equity, and it can be a straightforward update when you talk about innovation of product delivery rather than product itself. So what I mean by that is that creating some type of national market with no assessment zones and using and decoupling the fundamental connection of race and the point of CRA, which is well established in legislative history, you turn the CRA into some market-based incentive plan instead of an accountability law of civil rights and inclusion of what it was meant to be. And I think some of the proposals coming from the comptroller fundamentally move very far away from what CRA was intended under a narrative of the need for FinTech innovation.
Thank you very much. Mr. Rubenstein, or is it Steen?
Stein, thank you, Congressman.
At some point, you'll have to tell me when it's Stein as opposed to Steen. I'll look forward to the conversation. But let's talk about data protection. And I'm concerned about data protection from hackers as well as attackers. The hackers are the folk who would want to have some personal gain as a result of their dirty deeds. But the attackers can be nation states who want to disrupt economies, who want to sow the seeds of discord within a society. So the question for you is, how do we protect ourselves from hackers as well as attackers, given that we've had some unfortunate circumstances with voting in the United States, questions about Russian intrusion into an election? Help me, please, and you only have 20 seconds to do it, and I apologize.
Congressman, that's a big question that we work on every day. At Fidelity, we employ every modern technique we can, plus we have a group focused on emerging techniques, but we do fight off hackers and attackers on a regular basis. Our job is protecting those assets, which is why we're so concerned about other firms that have access to things like IDs and passwords or access to the customers, access to their site, that we need to protect against every different type of attack. We can certainly follow up with you afterwards.
Thank you very much, and thank you for the extra 18 seconds, Mr. Chairman.
Thank you, gentlemen. Time's expired. With that, to go to the gentleman from Kentucky, Mr. Barr, recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Harrison, wanted to ask you a little bit more about how FinTech partners with community banks. And, in rural Kentucky, we have a lot of community banks, but maybe not as much FinTech. But explain a little bit more how FinTech companies can expand access to financial services in rural America.
Well, thank you for the question, Congressman Barr. I believe that Elevate in particular has a unique way of actually approaching our customers to evaluate what the actual need is. And we'd love to be able to partner with more community banks to design different types of products. I mean, I think that, our prowess in technology and coupled with the kind of high-touch environment and the really more intuitive understanding of the customer from the community banking institutions will help to marry together much more efficient, much more safer, and more relevant products that can actually help us to reach broader communities also.
We continue to hear that the Modernizing Credit Opportunities Act, the True Lender, solution, and the valid when made legislation are critical in terms of removing the impediments to expanding and amplifying the FinTech community bank relationships. Can you explain, and obviously we recognize that the Treasury Department has made those recommendations to get those solutions into permanent law. Can you explain to me how those solutions would expand access to more services and products?
Absolutely. I think that community banks in general have been hesitant to engage completely with a lot of FinTech companies because of regulatory, the lack of regulatory clarity. I think with that types of clarity and continuous to have conversations and dialogue around those regulations, that FinTech companies will absolutely step up to the plate and make sure that we are in compliance with all of those, and to make sure that we assist the bank in keeping their good rapport with the bank examiners and their regulators as well.
Mr. Price, can you comment on the same question? Tell us why the True Lender and the valid when made solutions would be helpful, or how would that change the landscape?
Thank you for the question, Congressman. I think what FinTechs can bring to the table sometimes is edges of innovation and ways of doing things. Now, those things have to prove themselves out through the next cycle, and I've been through 3 or 4 of those, and I'm sure they're mindful of that. But I struggle sometimes. I mean, we, probably 3 or 4 years ago, we met with probably the top 5 alternative lenders in the country, and they weren't that interested in talking to us. And they came back to us a few years later, very interested in using our balance sheet, but they still own the customer. So what we've done, quite frankly, is we've developed our own online lending capability and deposit gathering capability. And we will continue, and I'm sure we will have some partnerships. We certainly have it with FinTech companies and other disciplines, whether it's personal financial management tools, et cetera. But lending, we just haven't struck a chord yet.
On this question of greater harmonization and uniformity, Mr. Estrada, I was struggling a little bit with your testimony. Can you explain why you're so averse to better harmonization and uniformity?
Yeah, I mean, it's not so much that we're opposed to as the legislative effect that this would have on consumer lending. I mean, I think taking an expansive view of predatory lending, you know, the difference between getting an 800% APR loan and a 90% APR loan nominally is a plus. But when you look at the consumer protection issues of state preemption, when you look at no matter whether you default on a 90% loan or a 100% loan or a 300% loan, the impacts of that default are real. So it's a question of affordability, and it's a question of ability to repay, and it's a question of underwriting. So what these bills would do on the true lender aspect would be ignore what seems to be called friction in the industry as a legal tool to root out sham lending arrangements.
Well, you know, if we did an OCC charter, it would be optional. In other words, it wouldn't be a mandatory preemption, it would be optional to access a federal uniform interstate harmonization, right? So it wouldn't necessarily preempt state consumer protection laws.
I thought you were referring to the valid when made and true lender bills, not the OCC charter. But yeah, that's a semantic difference for us, a real one. But I think the legal theory behind the true lender bill would ignore economic reality in favor of fiction of just who's on the dotted line. And that comes at the expense of a legal tool that has historically been very effective in rooting out sham partnerships. On the valid when made aspect, I think the legal theories that the bill relies on, and I borrow this analysis from Professor Adam Levitin, is incorrect, that there is no longstanding valid when made doctrine. The National Bank Act wasn't even passed until 1864, and that in his research he's found no cases that deal with usurious assignments until the late 20th century. So the Nichols case that the bill relies upon, I think, is an overreach in terms of the conclusion of defining the problem that the bill seeks to solve, and the consumer impact reality of what that bill would do would, one, rob the legal system of calling out and investigating sham partnerships, and on the valid when made, create a great benefit for secondary market securitization, but at the cost of unaffordable lenders taking a very expansive view of what predatory loans are for the consumer. Sorry for going over.
Gentleman's time has expired. With that, we go to the gentlelady from New York. Ms. Tenney is recognized for 5 minutes.
Thank you, Mr. Chairman. I thank the panel for being here today. It's an interesting topic, and I first want to address my question to Mr. Harrison. You mentioned the term banking deserts, and I have a region, I represent central New York, upstate New York, and we have a lot of bank deserts. I have an entire town that doesn't even have a bank. I mean, they have to go to an ATM. And we have a lot of small community banks that have been lost. A couple of them have been preserved, especially thanks to the latest reform that we did to give them a little bit of a break on a number of issues, especially the Dodd-Frank reform bill that we recently passed, 2155. But we still have an issue where I met with a number of the community banks, and they were concerned when they talk about FinTech. They're concerned that there's somehow a person behind a computer and they don't really know the face and the name. And so I'm curious about the possibility, and I'm open-minded about the possibility, if you could just explain a little bit about sort of the rural, maybe and possibly even in urban areas, although I have small urban areas, how FinTech can partner in a way with community banks that's transparent, that gives people the confidence they have in their hometown community bank. If you could just give me just a quick way that you think maybe 1, 2, 3, what the best ways you can do that are.
Sure. Thank you for the question. I think that where we can enable different types of technology to reach customers in those rural areas is truly by using kind of online resources and being able to partner with the banking institutions in community areas to find out how do we get to those customers. I think that we've been able to really kind of go into communities that are, again, predominantly with payday lenders, and we've been able to bring those customers back away from there and understand that they can access a lending platform through their mobile phone, over the internet, in a lot of different ways, and be able to get fast decisions that they don't have to wait for long periods of time in order to know when they're, when they've been approved or not. We've been able to save customers over $4 billion over the as an alternative to payday products, and we believe that we can get even better than that as we continue to reach out to those customers.
Yeah, can you just get a little more specific? So how you say we can get to the customers. How do you actually get to the customers? Because these are presumably the bank's customers.
They are.
Or in their bank's customer. How do you work with the bank and partner with them so they don't lose their customer base, so they're not obliterated by some of these huge banks that come in and, they're on an 800 number. I mean, I love my bank. I can walk in. Yes. It's a lovely little community bank. It's been around for over 100 years. I can still walk in and hand my checkbook to the note teller, and she balances my checkbook while I go and talk to the bank president. I mean, it's that close community feel that I know that I can trust them. But what do you actually do? I mean, do you partner with the bank
to
reach the customers? What's your marketing plan to get to them?
So we've talked to bank presidents that have actually told us, I have customers that have a checking account with me that have a 500 FICO score, but they don't qualify for any lending product that I have because the lowest that I can go is 700 on a for their lending products. And what we've been able to do is talk to them about what is the actual need. And a lot of times they'll tell us that they are short-term loan products, and it's within our wheelhouse to do. So we will absolutely partner with them to market to them through either direct mail, or we can actually create programs that market directly through the banking institution itself.
So how do you actually provide the service? It's like a service for the bank in the partnership. So you would say, we're going to provide you some, save you costs to the bank, for example, a small community bank on online. How do you partner with them in a regulatory environment like, say, New York, where it's very difficult to do anything, let alone partner, as an outside company, an outside financial institution trying to work within maybe a community bank atmosphere to help them with their online presence? Or, I mean, how do you, I don't mean to get into the detail too much, but how do you share profits? How do you make a decision about whether a loan is going to be made or not? Does the community bank make that, and who bears the liability? Does the FinTech company bear the liability, or does the small community bank?
The bank is always absolutely the lender in these business ventures, and we are simply a service provider to them. We help to enable them to do this outreach to their customers through a lot of different channels. We look at what they are currently doing, and then we talk to them about what are the ways that we can more cost-effectively outreach to those customers. We have a lot of infrastructure ourselves. I mean, we're a huge direct mail marketer.
Quickly, before, do you have any of these kind of partnerships with community banks right now?
Yes, we do.
You do?
We have a couple of bank partnerships, one in Provo, Utah, one in Louisville, Kentucky, where we've partnered with the community banks to actually help them to enable a national product.
Thank you very much. Appreciate it. I think I'm out of time. Thanks so much.
Thank you.
Gentleman's time has expired. With that, we'll go to the gentleman from Georgia, Mr. Loudermilk.
Thank you very much, Mr. Chairman, and thank everyone on the panel for being here today. Look, as spending over 20 years in the technology sector, finding ways to use technology effectively, efficiently, and securely to improve our quality of life, to improve efficiency in business is extremely important to me. FinTech is also extremely important in my district. Georgia is the home of FinTech, where 70% of our nation's payment processing is done. We're also considered the Silicon Valley of the South. A lot of startup businesses beginning in Georgia. Our legislature, working with our legislature to make sure that we are doing the right things to keep those businesses in Georgia as well. I'm very excited about a lot of what we're doing, but from a cybersecurity aspect, I do have some concerns. That's one thing we've been working on as a committee is the patchwork of standards that we have currently regarding data security, protecting personal privacy, et cetera. And our committee just passed a bill a couple of weeks ago that would help with that. So my questions are going to be around this area as far as the regulatory area regarding cybersecurity, et cetera. First question, Mr. Price, why is it so important for consumers in different states to have the same expectations of data security standards that their bank or credit union must adhere to?
I think because lending people money or taking deposits is serious business. A new house, an education, a car, these are seminal moments in people's lives, and these decisions kind of demand people's attention and a lot of carefulness and thoughtfulness on our part as well. The other thing I would add is, as a bank, we're subject to something called FFIEC guidance, and it's part of the regulatory standard. It's 4 or 5 standards. It includes everything from tabletop exercises, ethical hacking, phishing exercises, are all part of evolving our defense continually when it comes to securing data and protecting customers. And I do think the standard is higher for community banks than it is for our FinTech partners. I think they have more of a reactive regulatory framework with FTC and a safeguard type of approach. And my comments earlier were, I think the playing field should be level, and I think that's fair.
Follow up on that. What are the compliance challenges that the industry faces with the patchwork of sometimes conflicting data security and breach notification laws?
I can't speak specifically to that, other than to say in general, we've gone from 14,000 to about 6,000 community bank. That's not the answer to banking deserts. And I think regulation has, the bar has been raised. We got some recent relief, thank you. But I think the regulation needs to be consistent, from FinTech to bank to big bank, community bank, and appropriately tailored, if you will.
Okay, I appreciate that. I've had some in the financial services sector come to me and complain that if I'm in compliance in one area, I'm out of compliance in another just because of the conflicting nature of these. So I appreciate that. Mr. Rubenstein, an off-the-wall question, since people use your name quite often. What's the preferred pronunciation of your name?
My father says it's Rubenstein, so I go with that.
Rubenstein, okay. I've actually heard on not regarding you, but another quite notable Rubenstein. In one newscast, the reporter will use 2 pronunciations of the same name. So thank you for that clarification. I want to be respectful. Mr. Rubenstein, understand your company's developing innovative new ways to protect your customers' data when they use third-party data aggregators by eliminating the need to copy usernames and passwords onto third-party platform. Can you just kind of elaborate how that works?
Yes, Congressman, thank you. It's not only our company, the industry is moving in this direction. So data sharing has been going on since the mid-1990s. The cybersecurity environment, as we all know, has changed dramatically. So what we're doing is we're working with fintechs, with aggregators, and with banks and brokerage firms, platform providers, the core providers that Mr. Price referenced, in ways for consumers to actually affirmatively instruct their institution, so basically log into their institution and say, yes, please share my data with this third party. So they go through the authentication, not with a fintech, but they go through it with their institution. What that does is that permits their institution, 1, to set up a secure connection, 2, to help the consumer monitor that on an ongoing basis. So the consumer doesn't use an app and forget, meanwhile the data is still being harvested. And number 3, it provides a way for the consumer to go to the institution and say, I don't want to use that anymore, and revoke that consent.
Okay, thank you. This is the type of innovative thinking that is very beneficial to the industry. Mr. Chairman, thank you for the time, and I yield back.
Gentleman's time has expired. With that, we go to the gentleman from Colorado, Mr. Tipton, is recognized for 5 minutes.
Thank you, Mr. Chairman. I apologize, was running late, had another meeting to be able to be at. But Mr. Harrison, wanted to address you maybe first. I represent rural Colorado, have a lot of small communities, a lot of underbanked people, and I think that a lot of innovations to make sure that we have a fair and level playing field for these rural communities and the underbanked to be able to participate is incredibly important for us. Can you maybe expand for me at least how your business, why you deal with the banks, and how this is going to be benefiting some of these rural communities, why that's important?
Sure. Thank you for the question, Congressman Tipton. Again, I believe that our partnerships with banks give us a better insight to what consumers actually need. I think that banks have attempted to serve their customers in a way that we are just evolving to really understand. Although I will say that we've take a very customer-centric approach to design of all of our products, where we start with what does the customer actually ask you for, and how do we best anticipate their needs in the future, so that we're not just a part of an immediate need, but also what is the life cycle of that financial life after we go through that. So we will work with our bank partners to actually create these products, and then also help to enable them as their service provider.
You know, one of the issues I really hear, Mr. Harrison, at home from a lot of our small community banks in particular is they'd like to be able to do something, but regulatorily they're inhibited from doing something. Yes. Are there any regulations maybe that you can point to that are inhibiting you from being able to work with some of these small community banks?
I think true lender. The true lender rule, I think, is the one inhibitor that would help us to provide some clarity, and establish the bank as the true lender. We're absolutely ready to engage in any dialogue that's necessary in order to kind of clarify what that truly looks like from a practical business perspective. And I think that a model that Elevate has actually established with our banking partners is one that actually we can use as a proxy to better inform and refine that for the entire industry.
Out of the Treasury report, are there some particular things that you would point to that would help a company like Elevate?
I'm sorry, can you repeat the
question?
question?
Out of the Treasury report, is there anything in particular that you could maybe point to that might be able to help Elevate and other companies be able to reach out?
Well, I'm not as familiar with the Treasury report, as that's more recent to me, but I'd be happy to go back and look at that and get back to you on that for sure.
Great, thank you so much, I appreciate that. And Mr. Rubenstein, great to see another Rubenstein up here, and glad to have you here. Can you maybe detail briefly what the work and benefits that you've been working on have yielded really to our consumers?
Congressman, thank you for that question. The work we're doing is really to protect consumers. We have 30 million consumers, $7.3 trillion in assets that we need to protect. So it's all about protecting consumers from insider threats, right, from individual hackers, and from nation-state attacks. It's not only protecting them when they're at Fidelity, but it's helping to protect them when they decide to use some other service where they connect their Fidelity account, or in the larger world, to connect any institutional account. So we believe that we're trying to move to a space where consumers understand how their data is being used when they share it, that they're able to monitor that on an ongoing basis and able to revoke that consent. I give a few talks on this topic. I also often ask people to use this, a personal finance app, and some people say, yeah, I used to use it. So I said, well, what did you do to stop using it? The number one answer is I stopped using it, and the number two answer is I deleted the app from my phone. Neither one of those two things actually stops the harvesting of consumer data every day. Right? If we can change the way consumers authenticate and the way they control that flow, we can put the control back in the hands of the consumer so they know how their data is being used and they can revoke that consent at any time.
And what exactly can consumers do? That'd be my response. I just delete the app, but
So today, consumers have to remember all the different apps that they used and go into those apps and actually request for it to be deleted or request for their data to harvesting to stop. They could change their password on all their financial institution sites. That's a hardship, and then people don't remember the new password. Or we could just flip the model upside down so that they can get a dashboard at their financial institution, whether at their bank, their brokerage firm, or wherever, where they can have that dashboard, see what's going on, and be able to push a button and revoke access.
Great. Thanks so much, Mr. Chairman. My time's expired.
Gentleman's time has expired. We go to the gentleman from North Carolina. Mr. Pittenger is recognized.
Thank you,
minutes.
Mr. Chairman. Appreciate it. Thank each of you for being here with us today. Mr. Cutler, before I start, by chance, are you related to a John Cutler?
I am not, Congressman Pittenger.
Well, he had a very major effect. I always claim him anyhow.
Okay, I will do that,
On
sir.
policy, outside person, big major policy person in the 70s and 80s. So just be aware of that. Ms. Cutler, regarding data sharing as it plays a major role on the international stage, are there international standards or procedures that you would recommend or drawbacks that you would see relative to what could be done in our own U.S. financial system?
Absolutely, sir. In my written testimony, I reference several times the UK and their standards. I think we should look to what the UK is doing in the Financial Conduct Authority, FCA, as a good model for what we should look to. And I think in the Treasury report, they point to that model several times. So I think we should look there.
Thank you. As you know, the Treasury report calls for greater harmonization among state regulators for licensing requirements. To that end, since many fintech companies are subject to these state regulators, are varying licensing requirements between states impacting the ability of fintech companies to provide new product innovation?
I think that, Congressman, that's a great question. I think there needs to be more state harmonization. It's a real hindrance right now. It's an expense for fintech companies to apply for these state licenses that are very similar, but also different. So they have to go through the process, they have to apply, they have to pay the fees. It's very time-intensive, resource-intensive. If there was a streamlined process, it would save a lot of resources.
Thank you, sir. Mr. Price, your testimony discusses the importance of partnerships between the banks and the tech companies. To that end, does the current regulatory scheme hurt banking innovation?
I think to the extent that there is not a level playing field, it does. I mean, I'll just give you one example in payments. If you're a FinTech, if you're Square, you can put in a touchpad and you can get into your account. If you're a bank, you can't do that. So that's just one example. So the playing field is not level between banks and FinTech companies.
Well, to that end, what changes would you recommend to encourage innovation?
I think a level playing field between banks and fintech companies. And if you're in the banking business, you have regulatory oversight, CRA, HMDA, fair lending. And if those regulations need to be modified or changed, we can do that. But it should be the same for anybody who makes a loan or takes a deposit.
Thank you. To each of you, I would ask, cybersecurity, of course, is one of the most important issues facing companies of all kinds, especially in the wake of the Equifax breach. What steps do banks take to protect personal identifiable information, private financial data? Who would like to answer that?
We have, as I mentioned earlier, FFIEC guidance, which is regulatory guidance. We do everything from tabletop exercises, ethical hacking, phishing exercises. Our enterprise risk culture around this is evolving constantly, and we get regulated on it every year by a state, Federal Reserve, and the FDIC. And so that's incredibly important to us.
Thank you. Mr. Rubenstein, did you want to say something?
Congressman, this is an area of extreme concern for us. It's the #1 thing we focus on. As a large institution, we have over 700 people who are focused specifically on cybersecurity. We get attacks just about every day. We fend those off. It's an ever-escalating battle of firms like ours employing new tools, the bad guys employing new tools. One of the reasons we're so passionate about this data aggregation and changing the models, we often find criminals take user IDs and passwords that they find on other sites, right? So we've all heard about big hacks that have happened at low-risk sites. They take those credentials, they go open an account at a FinTech impersonating that customer, They use those, log into a bank or a brokerage firm, they find valid ones, and then they use those as means to attack. So we have to defend against that as well. It's an ever-escalating battle that we're extremely focused on.
Thank you. My time has expired.
We have a couple of follow-up questions here for some members, so we'll start with Mr. Barr for a second round. Thank you.
Yeah, thank you, Mr. Chairman, for the follow-up. Mr. Cutler, Mr. Harrison, you heard my question and Mr. Estrada's answer and his defense of the state-by-state regulatory model here and the applicability of state usury laws. And Mr. Cutler specifically could give you an opportunity to maybe respond to that given your testimony here today in defense of a clarification of true lender and valid when made doctrine. And I just invite you to respond to his testimony if there is a counterpoint.
Thank you, Congressman Barr. Now, in my opinion, a handful of court decisions have wrongly called into question whether the bank is the true lender in a bank fintech company partnership. These court decisions are based on a predominant economic interest test that is subjective and that can be cited to conclude that the fintech company is the true lender in these circumstances. Whether the bank or fintech company is the true lender may be the difference in determining whether the loan is void or uncollectible. And I think personally that it's the uncertainties having a chilling effect on innovation here. So I think it's important to address this uncertainty, and I think the legislation that has been passed has been helpful, and it'd be important to go forward on that and get signed into public law.
What would be the argument to restrict the transferability of loans? What's the argument in favor of that?
I don't see it. I don't see it. I used to be, when I first started my career, I was in the securitization business, and when we were in that business, it's clear that you know, the rights in the loan followed when you transfer it. So it doesn't make sense to me.
Mr. Harrison, can you chime in on this issue?
Yeah, absolutely. I mean, I support Mr. Cutler's responses, and I believe that, you know, support for clarification on true lender and also to support on valid when made is substantiated. I don't believe that there's any intent from the fintech world, you know, to harm our customers in any way in particular. And I think that, again, you know, we will abide by regulations as our banking partnerships are dictate, and we will continue to try to do everything that we can to protect our customers.
If Congress does not clarify this issue, tell me about the impact on innovation. What will be the impact on innovation if there continues to be this uncertainty in the legal world on the transferability of loans?
Yeah, as much success as a company like mine, Elevate, has had, I mean, there's still 160 million Americans that have credit scores that are below 700, and we've, you know, been able to serve a couple million of those, but we're only really scratching the surface. The reality is that these bank partnerships with FinTech can help us to enable, you know, another multiple of us being able to reach out to those customers and be able to understand what needs do they actually have so that we can design better and more safer products for them in the future.
And in states where, you know, in rural America, like my district, where you don't have access to FinTech and you don't have access maybe, and if bank FinTech relationships are not allowed to flourish, what does that mean? I mean, does it mean more bankruptcies? Does it mean more overdrafts? What's the impact on those underserved borrowers?
Yeah, I think it does from a macro level, but from a micro level, I mean, when you look at the impact to the customers every day, you know, we have customers that don't have the money that they need for medical expenses. They don't have the needs that they have for home repairs and car repairs. And these, you know, customers that are in these rural areas, not only do they not have access to banking institutions sometimes, but they also don't have, you know, immediate access to food or to, you know, just basic needs that they have in order to kind of continue their life. So having that outreach and enabling them and giving them the resources that they need to kind of maintain their lifestyle is a huge impact from a practical perspective.
I really appreciate all the testimony today. I think FinTech is a huge opportunity for American consumers, particularly underbanked consumers, people who live in economically distressed places in rural America. And I think Congress does need to start getting serious about creating a legal landscape that allows these relationships to flourish so that underserved populations can have access to these very innovative products. Thank you, and I yield back.
Gentleman yields back. I've just got a couple follow-up. Mr. Estrada.
Can I just request 30 seconds to answer the Congressman's question of why you would restrict it? I just think is really core to this, if
Sure.
you permit me. I don't want to restate the point, but I think one of the best reasons to restrict the transfer of loans is when the very model itself has been hijacked by unscrupulous lenders. And I know we can talk about intent, but if you look at page 6 of my testimony, it's not about intent or subjectivity. Like, the default rate on the securitization of marketplace loans have skyrocketed in the last year and a half. So whether there's an intent to harm or not, the consumers are bearing the risk of those failed loans, and marketplace lenders are able to pass it off in the secondary market. And there's the cases that some of these marketplace lenders, really big ones, some that you hear from every day, their defaults are in the double digits. Their default rates are close to 50. Their underwriting is passing the risk to failure to the consumer and the cost to the investor. So that's why we're so adamant about restricting the transfer of loans in this model. Thank you for the extra time.
I have a couple follow-up questions. I just want to, Mr. Rubenstein, you've talked a lot about the control of data. And I would just like to get on record that who actually owns the data? Do you own the data? Does the consumer own the data whenever they give control to you by signing it away? Or have they given up control of it? Give us exactly where this all sits so we know, because we have to build on that very premise and that information to be able to understand what we're doing here.
Yeah, we come from Congressman, we come from the very simple place, a very straightforward place, I should say, that the consumer should be able to share that data as
Is there something in law? Is there a legal basis for the consumer owning his data somewhere?
I'm not a lawyer, so I apologize. I actually don't know if there's a basis in law, but we take the perspective that the consumer should have access, and I think Section 1033 of Dodd-Frank calls for the consumer to have even electronic access. We do think the consumer should have access, as well as be able to use that data in a safe, secure, and transparent way when they want to use it. So if they want to use it with a lending application, or if they want to use it with a budgeting application or anything else, they should have that ability, but they should also know what they're getting into. That the data should be used at the other side for the purpose the consumer thought it was. If they think they're using a budgeting app, they should get a budgeting app. It shouldn't be that that's a Trojan horse for the gathering, accumulating, and reselling of that data. Perhaps if the consumer wants to permit it for that purpose, the consumer should be able to permit it for that purpose, but they should know that that's going on. We think that burying something on page 35 of a privacy policy doesn't help the consumer understand how that's being used, and we need to see more explicit consent from the consumer for how that data is used, and again, give them the right to revoke that consent at any time.
Very good. Mr. Cutler, one of the concerns I have is that with FinTech companies, a lot of them are startups, a lot of them are pretty thinly capitalized, and to me there would be seen to be a risk there, from the standpoint that if the economy turns down or there's a bump in the road or their business model isn't quite right, that there could be something happen. Would you agree with that, or is there a risk there? Are they all in good shape? Or, to me, for the FinTech guys to partner with the financial institution at some point would seem to be a good idea from the standpoint of securitizing their future there with some balance sheet strength. Would you like to comment?
Thank you, Mr. Chairman, for the question. I think both options are great. I think partnerships with the big banks and all banks and community banks should be encouraged, and those can be very beneficial. But I think we also want to encourage folks with an idea in a garage to start a new business, and if it has a little capital but a great idea, we should do everything in our power to give them the tools to succeed.
Mr. Harrison, I think you mentioned that 700 seems to be a magic number for the credit score for folks that you want to deal with. I saw an article in the paper this week that the new average for people in this country is now, I think, 704, 706, somewhere in that neighborhood?
Yes, sir.
And so if that's the average credit score, which is the highest in history, that means half the people in this country couldn't qualify for stuff that you're talking about. Is that right?
That's exactly right. Half of the population, a little bit over half of the population of the U.S. today does not qualify for mainstream products. And that's another reason why outreach to some of the community banks and being able to help them to design products that are safe and secure for their constituency is really important. Right? We want to be able to design even more products. We want to be able to leverage the fact that community banks and also just banking institutions in general have a lower cost of capital, which is really kind of a lot of their prowess and their understanding of the regulations and their oversight help us to make sure that we're doing this in a safe and secure manner. So we'll absolutely continue to kind of pursue these partnerships with banking institutions because we believe it's the right balance that we can have from the best of both worlds.
Mr. Price, would you like to comment on that?
I think the challenge is we've tried to forge these partnerships initially was whose customer is it? And if it's our customer and we have the checking account, the debit account, the credit card, a small business loan, and we're doing an alternative lending product, we think it's our customer. And that's been the flashpoint. And quite frankly, I think we'll forge through that over the next half decade or so, and we'll get to something we can both live with their business model and ours. That's
and
helpful.
I agree with Mr. Price. It's the bank's customer for sure.
Very good. Well, thank you, all of you today, for your fantastic testimony. I feel like the make-tag repairman here, the loneliest man in town, so it's probably time to go home. So again, thank you for your testimony. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for the response. I ask our witness to please respond as promptly as you can. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. With that, this hearing is adjourned.